The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome to Property Investing Matters, and thanks for tuning in. I'm always excited when we have tonight's guests on board because we get really deeply into some great tax information. My guest is, of course, Julia Hartman from Bantacs. Julia is a member of both the Australian Society of CPAs and the Institute of Chartered Accountants. She writes for investor magazines and is the co-author of the bestseller Saving Tax on Your Investment Property. Her latest book, Winning Property Tax Strategies, is a great book about property tax. Now tonight we are going to be talking about many different things, but we're going to start out with just what you should be doing as an investor, given that we're coming to the end of the financial year. Julia, welcome to the show.
Thank you for having me, Margaret.
So it's great to talk to you, and as I said, we're coming up to the end of the financial year, and there's always some things that we need to do to get ready for that, a little bit of housekeeping to do, and things that property investors often miss. So can you take us through what they are?
Well, they normally think about paying things like interest in advance and stuff like that to get the deduction, but remembering you're borrowing that deduction from next year when you might be in an even higher tax bracket. So I'd only be looking at those sorts of things when you're, say, going to take a year off next year and going to be in a low tax bracket, or you've got an extremely high year this year because you've had a capital gain. Now, if one of those things you're going to do is going to be interest in advance. It's not enough just to pay it off the loan. You have to make an arrangement with the bank that it is treated as interest. Otherwise, you've just made a repayment off the loan, not a payment of interest.
Yeah, I do find that often people do get that a bit confused and they think, I'll just throw in X amount of dollars representing next year's repayments and bring it ahead. But the arrangement has to be pre-made with the bank before you go ahead and make those payments. Julia, what happens if you prepay 12 months worth of interest, but then during the next 12 months the interest rate goes up?
Oh, well, that's a win, isn't it? You've done something. The banks have accepted that. I mean, you're the loans officer, but normally those sorts of agreements with the bank, they say, do you want the option of paying the next 12 months? And they set the amount for you. So you
I just wonder whether, like the last year would be a good example. Are those people who paid well ahead of time and interest in advance, are they now, in a debit situation where they've got more interest to pay yet? Or does the bank just accept that they're the loser under those circumstances?
Don't think they'd ever be the loser, but would seem to me, if they've sent you a letter saying, yes, if you want to pay the next 12 months, this is the amount to pay, which is how I normally see it come across. That's the done deal. Yeah.
You'd think it was a done deal, wouldn't you? I'm going to look into that because I think that's an interesting one. All right, what else can we do before the end of the financial year?
Well, usually the place to look is repairs and maintenance and improvements and replacements in its entirety. So replacements in entirety is the whole hot water system, but I'm basically talking about plant and equipment. Now, repairs, you're going to get a deduction straight up for the repair. So that's the sort of thing you race out and incur before the 30th of June if you want the deduction this year. In other words, you accept the quote from the builder and say, go ahead. It doesn't have to be that you've actually paid the money over. But you've got to make sure it's not an improvement. So you can't take it beyond the condition the house was in when you bought it. Otherwise, you're stuck with just depreciating that cost over the next 40 years. And from the repairs or the improvements, you cut out any plant and equipment, such as hot water systems, fans, stoves, dishwashers, that sort of stuff, and you depreciate them over their life. So you can see spending money on a dishwasher in the last month of the year It's going to give you very little depreciation unless the item is under $300 per owner. In that case, you're allowed an immediate write-off on that.
So if I bought a $600 dishwasher, but I own that property jointly with someone else, then that qualifies, doesn't it? $300 each.
Yes, and you've done very well to get it for $600.
Oh, you go to Aldi. They have them for, I think, 400. So, okay, so we understand that we can, anything that's under $300 or anything that's a repair, everything else, if we're buying an asset, we have to then depreciate that. So unless it's one of those big assets, then it's probably not going to get us a lot. Is there anything else that we should be doing before we get to the end of the year?
Well, the big beat up now at the moment is get your depreciation schedule done for the building. And yes, if you do it before the 30th of June, then you're going to get to claim the cost of that depreciation schedule as a tax deduction in this year's tax return. If you do it after the 30th of June, then you've got to wait another year before you claim it. But this gives you a bit of a risk in the fact that you haven't consulted with your accountant at this stage as to whether you really need a depreciation schedule. And it's usually for people that have just bought a property, and the property has to have been built or improved considerably after the 16th of September 1987 to make it worth the cost of getting a depreciation schedule.
Can we also point out here, since we are talking about depreciation schedules, that there can be a downside with claiming depreciation along the way, in that it gets added back to your cost base or essentially deducted from your cost base when you sell, and that potentially exposes you to a greater amount of capital gains tax at a time that you might not want to get that.
Yeah, but effectively it's half. So I'll just explain.
Yes.
So if the property was built after the 13th of May 1990, if your property was purchased after the 13th of May 1997, then you have to reduce the cost base by any depreciation claimable. Now, the word says claimable, but if you don't have a depreciation schedule to allow you to do that, you don't know the actual cost, then it's not claimable. And even if you have a depreciation schedule, and you haven't claimed in past years, it's only claimable up to the amendment period, say to 2 to 4 years that you can go back. That is the amount that has to be added back to the cost base, reducing the cost base. Now, if you reduce the cost base, you increase the capital gain, because the capital gain is the difference between the cost base and the sale proceeds. So when you work out the capital gain, you apply the 50% capital gains tax discount to it, and then you pay your tax. So that reduction in the cost base should only have half the effect on it that all those depreciation deductions got for you during the time that you own the property.
So let's say you had it for 15 years, you claimed $100,000 in total depreciation, and I'm assuming the add back applies to both the building depreciation and the fixtures and fittings depreciation as well, back from the times that you could claim those. That's another discussion about what you can and claim now, but in the olden days you could claim them. So let's assume you've claimed $100,000 worth. Basically, it exposes you to an extra $50,000 in taxable gain.
Yes, for the 100,000 deduction, but I did want to clarify a bit about that plant and equipment. That's a completely different treatment. What happens is plant and equipment that's been depreciated, so this does not apply now to new properties, not brand new properties, but recent properties that don't qualify for plant and equipment depreciation. It just applies to plant and equipment that has been depreciated. It's a separate asset from the house. So when you look at the purchase price, you remove the value of the plant and equipment at that time. And when you look at the sale proceeds, you remove the value of the plant and equipment at the time of the sale. And you deal with the difference there in the depreciation schedule for the rental property, not as a capital gain.
Okay, let me see if I've got this right. Just say you had a total of $50,000 worth of depreciation you claimed on fixtures and fittings. You take that off and you add that back on. So I don't understand that, but Maybe you can explain that better.
I don't blame you. But it probably could work out approximately like that, but it's not meant to be that way. It's supposed to be the market value of that plant and equipment. Let's just do one hot water system for starters. So the market value of the hot water system when you bought was $1,000, so you reduce that off the price you paid. And by the time you get around to selling it, the market value of that hot water system is only $300. So you can only reduce the sale proceeds by $300 to cover that. And then you go over to the depreciation schedule and you say, what's it written down to? Oh, it's written down to 300 anyway, so I don't have to do anything there. It just cancels itself out.
Right.
So you reduce the good stuff, the purchase price by 1,000, but you only got to reduce the selling proceeds by 300.
Right, okay. So hence you need an accountant to help you work through particular things like that. Julia, is there anything else that investors should be thinking about now, being June, before we get to the new financial year?
Not that I can consider that would be any different. Just get all your records in order. Don't make sure you take them all to the accountant in one go. Dribs and drabs means you get put behind the desk and you're waiting months for your return because it's, you have to keep on picking it up. Other than work-related expenses, which is not the right topic for here.
Yes, no, then let's not get into work-related expenses. All right, well, let's go so we've talked about what happens with all that claimed depreciation when you do sell a property. One of the interesting things, though, is you've said, so if there's depreciation and you know there's depreciation, but you don't claim that depreciation, does that make a difference?
Yes, so the principle is that you should not be compelled to pay for a quantity surveyor's report just to calculate your tax. It's got to be an elective thing. So if you haven't got a quantity surveyor report and you haven't been claiming depreciation the whole time you own the property, then you don't have to add it back. But that's where the word claimable comes in the legislation. If 1 year you decide not to bother claiming the depreciation because you're in a low tax bracket, doesn't matter. It was claimable, so you have to reduce your cost base by that amount anyway.
Okay. All right, well, again, you need an accountant to help you through all of that. The next one I'd like to talk about is one of those things that can be a little bit deep and confusing for people. And I often hear you talk about the nexus between borrowing and expenditure. I often see investors who might spend money on something for their investment property and then they pay themselves back for that expenditure. And I know that you always say that we start to get into dangerous territory when we do that sort of thing.
Yeah, well, the main principle is what the money was used to buy determines whether the interest on the loan is tax deductible. So it's a very strict, tidy nexus. And this is a problem also when you repay yourself the deposit you put down because you hadn't organised the loan at the time. So when you withdraw from the loan and say that's to repay you for that, it's not the way you test it. The test is you've withdrawn from the loan, what did you spend the money on? If you spent it on groceries, then that's it. It's been used for private purposes. So you've got to apportion that loan now between the part that was borrowed for private purposes and the part that was borrowed for deductible purposes, and the interest is apportioned on that basis. And that's not a straightforward calculation. It gets messy, and my strongest recommendation would be to get the apportionment calculator off the shopping page of our website. But with the deposit, people quite often get caught this way more than anything. Because the bank says, oh yeah, we can't organise the loan yet at the moment, we'll get it organised, but just take it out of your offset account and reimburse yourself. That triggers the same problem. So the idea is that when you go to settle, you say to the real estate, give me back the deposit, I don't want that to go towards the settlement, and you borrow the whole amount of the settlement proceeds and that goes straight from the loan account to pay for the settlement.
Yep. There's two other ways that I think you can deal with that as well. One of them is to, before you get started, put in place a separate loan against your property if you're using equity that then becomes that loan that you use to make those initial deposits and pay stamp duties and anything else that you have to do beforehand. But that loan is separate from your own home loan, and all you do with it is investment property expenses. And of course, another way is if you can get a credit card that's just for your investment property and nothing else, and that's good on an ongoing basis to help you with any of those things that you might have to pay for. You know, I know there are always things that come up for me where I might get a bill for a property and I might want to pay it on my credit card to get points, for example, but then it gets all confusing when it's all got to be paid back because the credit card's automatically paid off out of my own money, and then I have to reimburse myself, and there that nexus is broken. So that separate credit card can often be a good way to deal with that, Julia.
Yes, that's the repayment principle, or refinance principle, sorry. So if you have a loan that's deductible and then you refinance it through another loan, as long as it goes straight through, it takes on the character of the original loan.
Yeah, exactly. So I find that all works pretty well to do it that way as well, and you're not breaking that nexus then. Julia, you wrote an interesting blog about what happens if your investment property is damaged by fire. And interestingly enough, in the last couple of weeks, I've had some inquiries from people just asking me about what they do. In some cases, it's just been some significant damage that's been fixed with an insurance payout. In other cases, it's been a complete burn down that's been rebuilt. And in other cases still, there's been a cash settlement made on the investor, and then the investor decides what they want to do from that point of view, whether they want to just try and repair, rebuild, or sell an empty block of land. Now, I know this is a bit of a minefield. Can we deal with those circumstances and tell us how it goes?
All right, I'll start with the last one you said and see if you're bored by the end of just explaining that. So you've got the situation where the house is burnt down and the insurance company says, right, here's $200,000. You can decide what you do with it. So you've got your $200,000. If you build to rent it out again, because I'm assuming a rental property here, if you build to rent it out again, then you get a rollover. It's straight off. It's fine. There's no, it all sorts out later when you sell the property for capital gains tax purposes. Nothing at the moment. So, but that's providing the rollover is conditional upon you using the property as a rental property after you've rebuilt. Now, some people rebuild and think, now I'll sell it while it's flash and shiny, and that's where the big trap is. So what's happened is when the insurance company's given you this money, you've said, oh, I could just sell the land and take the money and sort it all out now, or I could rebuild the house and I think I'll get more money, more profit out of this if I rebuild the house and then sell it after that. So that decision you've made is obvious by your circumstances that you've made a profit-making consideration in deciding to rebuild. So now you're in the business of building a spec home. You're building the spec home with the intentions of selling it at a profit. Otherwise you wouldn't have done it. You would have just sold the land. So now that you've got your business hat on, you've just blown everything out of the water. First of all, you've got to register for GST and charge GST or pay the ATO GST when you sell the property, which you don't get any more for the property just because you've got to pay the ATO GST. So work that out, because that's going to make a big hurt in your profit. You've got to make sure you've got a margin scheme clause in the contract, or otherwise you're going to pay GST on the value of the land too. Now, you're in business, so the profit you make is now business income. There's no 50% capital gains tax on the profit you make on the house. And of course, you lose that rollover relief on the insurance proceeds. So when you get the cash from the insurance company, you've now got a capital gains tax event on the house that you've got to pay the capital gains tax now in that year, and then deal with it separately later when you've got this business that you've rebuilt the house and on sold it. Now, you've also got to do BASs. It's a nightmare. Yeah, you wouldn't want to really rebuild with the intention of selling, because it just, without very detailed advice, you'd have to have a very good reason. Maybe you want to put a duplex on it so that you really make the most of the land. But it's still, do the numbers, be very careful. And if you've done this, you listen to this and gone, oh my God, what am I going to do now? Well, if you keep it as a rental for 5 years, then it's not a brand new property anymore. So then you don't have to charge GST when you sell. Even if all these other boxes were ticked, you kept it as a rental for 5 years, and because you kept it as a rental, well, then you do get the rollover relief on the insurance proceeds. So if you're caught halfway through this project, stop, keep it for rental for 5 years.
What about if, I had an example where a client had an investment property, there was a storm, they lost their back pergola, which was a vagola, which are very expensive. The insurance company settled on them for $20,000. Then they ended up selling the property and didn't get any less for it for not having a vagola. Is that $20,000 treated as anything, or is it just a windfall?
Okay, so that $20,000 would reduce the cost base of the property. So when you do the capital gains tax calculation, it would affect the cost base is reduced, so you've got a bigger capital gain.
I know you're there. I can hear you. I just can't see you. We'll come back to you. There you are. Okay, so we do have to consider that $20,000 and reduce the cost base for that $20,000.
Yeah.
And I guess the same would happen if the insurance company settled a sum on you for some damage to a property. Say they settled $50,000 on you, but it only cost you $20,000 to do it up. Technically, you should be reducing your cost base by that $30,000.
Okay, you're getting into another whole can of worms here.
I love cans of worms.
So what you've got is when they do a repair, which is a whole different thing because the place is still standing, then you've got an expense. So you've got an expense reimbursement, and that is a bit different. So when you spend, what figures did you use? You spent, the insurance company gave you 50 grand and you spent 20 grand on the repairs. Then you put the 20 grand in your tax return as an expense, and then you put 20 grand in as income. And that is how it offsets. And the other 30 grand can sit there indefinitely as not income until there's an offset of an expense that related to what they paid you that 50 grand for.
Right, okay, very complicated. So my advice is just don't have damage to your property, and if you do, don't accept more than what you're going to spend on the property, because it sounds a lot easier just to make it all very even and match up. Well, we are off for a 60-second break, but when we come back, we'll be talking more tax. So don't go away. We'll be waiting for you here as soon as these messages are done. Hi there, I'm Margaret Lomas. If you're a seasoned property investor, you probably already own a few properties, so you're likely busier than ever before. Why not let Destiny help you in the same way that we've already helped many investors with large portfolios by using Property Match to add properties which fit into that portfolio and address common issues that bigger portfolios can bring. Head to mypropertymatch.com.au to find out more, or give us a call on 1300 My Destiny. Welcome back. You're watching Property Investing Matters on the completely free-to-air My Property TV and, of course, through iTunes and your favourite podcast app. I'm Margaret Lomas, and on the show and answering my questions is Julia Hartman from Bantacs. Julia, let's move on to the next complicated question that I have for you. And it's something that I think that viewers might find a little bit alarming, at least for those who are living rurally or who wanted a bit of a tree change. The tax treatment of someone whose principal place of residence is on more than 2 hectares can be tricky.
Yes, well, the main residence exemption only covers 2 hectares, 5 acres in the old currency. And that's got to include the land directly under your house, of course. But after that, you get to choose where you put it. So this is where the trick is. And you've got to do it right from the start. You've got to keep records on that property right from the start. Of course, regardless, when you sell, you've got a capital gains tax calculation. And I should point out the spreadsheet on the shopping page on my website that can help you do this and explain this that I'm about to give you a quick summary of. So you look at the land and you say, all right, over there, I'm going to have a business that I'm running. So you get the small business CGT concessions on that area. So you don't need to cover that with your main residence exemption. Now, to get those small business CGT concessions, you do have to run the business on the property for at least half the time you own it, or 7.5 years as a maximum. So you can see this is a plan that you get done at the start, and then you're pretty sweet for whenever you sell sometime in the future, just keeping the records. Because the small business CGT concessions generally can be worked around to get it down to no capital gains tax on that part of the property. Then you might say, well, there's another bit over here that's flood prone and it's worthless. No one will want it. It's just tacked on there, and there's an easement on it, or there's something like that. It's worthless now when I buy it, and it's worthless now when I sell it. So there's no capital gain on that. So I'll expose that area to capital gains tax. I won't use that up in my 2 hectares. It's covered by my main residence exemption. You can see it's worth having a value or walk over the land and make the plan from the start. Because once you've divvied it up like this, then you're going to divvy your receipts up that way and keep track of things that way, so that if there still is anything that's exposed, you can work out that capital gains tax for that. Now, some people think, oh, I'll just adjust cattle. That doesn't count as being used in a business. It actually is the worst case scenario, because if you adjust cattle on it, then you've used it to produce income, so that area can't be covered by your residence exemption. Even if you have spare part of that 2 hectares that you could cover it, you can't cover that area for the time it was used to produce income. So be very careful about adjustment. Other things people think of as cabins and Airbnb. Now, you have to be pretty business-like for that to get the CGT small business concession. So it'd virtually have to be a more or less full-time job for you for that to be considered a business. Yet, running your own cattle on it, yes, you might get the small business concessions for doing that.
Wow. I guarantee you that there are people all over Australia today who live on more than 5 acres and who have no clue that they are exposed to a capital gains tax. They would just assume that it's in their own name, it's their own place of residence, and therefore they're going to be okay. And I would also assume a lot of them have gone ahead and sold properties too, and never ever known that really they should be paying tax on a portion of that property.
Yeah, but it's pretty easy for the tax office to come knocking later and say, well, you know, we've got the titles office here. It tells us it's more than 2 hectares. So obviously you've got some capital gains tax to pay. Where are your records? And even the records you have kept, you've thrown out by then because you've sold the property.
I guess too, though, Julia, that in the case of most principal places of residence that are on more than 5 acres, that the acres apart from the 5 acres are going to be considered to be unusable in terms of you can't build on them, providing that you also can't subdivide at the time. Then the value of them would be probably quite small in relation to the value of that 5 acres with the home on it.
Yeah, well, that's a question for a valuer, but I would have expected it to come along the lines of if they're all similar, if all those 5 acres are all similar land, then we say to the valuer, how much is the house worth when we sell? So that's that much of the sale proceeds. The rest of the sale proceeds go to the land, and then we pro rata it that if it was 7 acres, say, well, 5/7 of that price is covered by the main residence and 2/7 is exposed to capital gains tax.
Yeah, it's very tricky. I'm sure a lot of people are caught by this and don't even realise, and it's definitely worthwhile if you're in a situation now, or if you're watching the show and you have a friend, a relative or someone that you know who is in that situation now, that you alert them to the fact that this is on the table for them, and there are things they can do beforehand to try to offset a little bit of that potential capital gains tax. You know, the last thing I want to talk to you about tonight, Julia, is a fairly in-depth question that I know will take a while for us to get through, but it's about how you buy property, and specifically really as an investor, because we often get our investors facing a choice of whether they should buy just in one name, being the higher income earner's name, whether that protects them, whether they should buy in joint names, whether they should set up some kind of complex structure like a company, or set up a family trust, or how they should buy property. So let's start at the beginning and go through this. When you're buying property, what do you need to consider when you're talking about just how and what entity to buy that property in?
Well, the first and major concern to me is if it's going to ever be covered by your main residence exemption, it has to be in your own name. So if you're ever going to live there, it's got to be in your own name. Now, if you're a member of a couple, it only has to be in one of your names, and you may consider that one of you has a lower risk of being sued, so you might put it in their name. But if you are looking for rentals, then most people look at whether it's going to be negative for tax purposes or positive for tax purposes, and decide which name to put it in depending on the person's tax bracket. Now, there's a couple of things you need to consider here. Is one, if you're looking at it being negative for tax purposes, it's not always going to be. Rents are going up and up all the time. It will become positive, possibly when the higher income earner is in an even higher tax bracket. So it's not as simple as that. And of course, when you have the capital gain, when you finally sell, because anything negative for tax purposes, you're looking to make the money out of the capital gain. When you sell, that capital gain is going to be taxed all in one person instead of being split over two people. That means only one person's superannuation concessions that can be used to offset some of the gain, and only one person's tax-free threshold and up through. So even if you wait until that person retires, you're still halving the tax things you can do because it was only in one person's name. And the final clincher is from the 1st of July 2024, the tax bracket from 45,000 to 200,000 is the same. All income in that bracket is only going to be taxed at 30 cents on the dollar plus Medicare. So you can see there'd be very few couples that aren't in the same tax bracket anyway. So why not go for both names, and then you can at least split the capital gain when you sell.
Okay, so let's move on to a company now. I know that often people are advised to set up a company to buy property. There are some drawbacks in that as well.
Oh yeah, that's the worst case scenario. So you don't get the 50% capital gains tax discount in a company. So I really hate that because, well, you've only got to look at the capital gains that we've experienced. You know, there's some properties now that their cost base is insignificant compared to their selling price now. So you really need that 50% discount. But also people think, oh yeah, but I'm in a high tax bracket, which has to be pretty high from the 1st of July. Because the company's in 30 cents on the dollar too, and anyone under 200,000, that's the most they're going to pay in tax. But if they say, I'm in a really high tax bracket, I only want the company 30 cents on the dollar tax bracket. But if you ever want to get your hands on any of that income that's been taxed in the hands of the company, then you have to pay the top-up tax anyway. So you're locking your money away. Might be a strategy if you want to buy lots and lots of property in that company with the retained earnings, and you never ever intend to sell. But I say never say never.
Absolutely.
So,
All right, what about the next structure that I know a lot of people set up, which is a discretionary or a family trust, often for the purposes of quarantining assets, so that if you are in a high-risk profession, they can be quarantined, but there are downsides to that too.
yeah, so if it's in a discretionary trust, then you have no ownership right. So if you ever get sued and the bankruptcy trustee sits in your shoes, then they can't get their hands on this trust either. There's been an attempt at it in Rich Stars, but it didn't ever get tested. So we're still pretty confident discretionary trust locks it away. It's got nothing to do with you if you're being sued personally. And from the other side, if the tenant sues you, they can't come in chasing your personal assets. It's just a bit more costly regarding accounting fees to run it, and the banks get a bit fussy about lending to trusts. But the ideal thing is when you have that big capital gain all in one year with a discretionary trust, you can distribute it to various people.
And you also get the 50% capital gains tax discount through a trust as well. So that's the added benefit. What about a fixed trust? I've seen some pretty complicated structures set up, Julia, for people, including a fixed trust somewhere along the line. What about that?
Right, okay. So the complicated structures don't work. The tax office has brought out several rulings on that. You're either going to be a discretionary trust or a fixed trust for the life of it, and the only way it's going to change is if you completely change the trustee to the extent that it's triggering a capital gains tax event anyway, so you don't get to muck around with it. So with a fixed trust, yes, they have some advantages. They still get the 50% discount, but a fixed trust means that you own the units in the trust, just like you'd own shares in a company. And this means that the bankruptcy trustee, if they're coming to get you personally, they then get these units in the trust and they then control the trust. So there's no asset protection as such because you own the units that represent the house in the trust. You haven't got any flexibility on distributing the income at the end of when you go and sell it, because it's got to go towards the units. And if you try and change the rights of the units, you've got the capital gains tax event happening anyway. The good thing is you can negative gear in your tax return, your personal tax return, which you can't do with discretionary trust. So if you say borrowed the money to buy the units in the trust, because the units in the trust give you a fixed right to the income, then you can claim a tax deduction on the interest from the borrowings in your name to offset against the income stream you get from the fixed trust. And for that reason, if you don't need to use the house as security that you're buying, then possibly the banks aren't going to give you such a hard time either.
All right, and there is one last structure that I know a lot of people are still considering using to buy property, and that's a self-managed super fund. Not quite as easy as it seems.
No, well, they're very expensive to run. So I hate it when I see these little units or something, one bought in one super fund and that's it. And you might think, oh, well, that's a stepping stone. I'll buy this one in the super fund. And because the costs of running a super fund are fixed, the more assets you have in there, the less onerous, I guess, the costs of running the super fund are. But the trouble is, how do you get more assets in there? So when you build up equity in an asset held in a super fund, you can't go and borrow against that equity to buy another property. That's it, it's locked away. You can only borrow once against an asset to buy in a super fund. And the interest rate on the borrowings are expensive. The big four don't lend for super funds anymore, so you're going to the boutique lenders, which expect a much higher amount. So you'd be looking, but I mean, the big thing about super funds is eventually when you sell, you're going to avoid all capital gains tax by simply putting your super fund into pension phase when you're over 60, and there'll be no tax paid when the property is sold. And even if you can't wait until then, you're only going to pay 10% capital gains tax on it in the super fund. And all your contributions to the super fund, you're going to get a tax deduction for, so that's the same in a way as having the property in your own tax return. But it's mainly the costs, and the slowness of not being able to use equity to borrow again. If you've got a lot of cash in super that can buy a couple of properties, then it's worth looking at. Anything smaller, and be careful who you're getting advice from, because you might be being spooked.
Certainly, I know with some properties that I have in my self-managed super fund, they did have loans against them, and the loans just got so high, and in the end we had enough cash in there to be able to pay off the debts on it, and it's made a big difference. And now, of course, that magic 60 number and putting your super fund into pension mode starts to make sense when you reach that age yourself, and you can then see some of the benefits. But I think people need to be careful at the front end, because a property in super, when you have it geared, needs to perform or way outperform a property outside of super just to cover the sheer costs of holding it. And often people don't get those properties to the end when they can be in pension phase, because the holding costs are just too great and they're not making any money out of it. And any money they're putting into their super is just propping up these properties, Julia, which is not what is meant to happen.
No, that's the real life scenario, what really happens, despite all the flash seminars.
Absolutely. Well, that does complete this week's serving of Property Investing Matters. If you want to share the love with your friends, remember that you can watch this episode and past episodes again, if you like, as many times as you like, either directly from the My Property TV website, or you may prefer to subscribe via iTunes or your Android podcast app to make sure that you never miss an episode. It's all completely free, so we do appreciate all the support that you can provide. Thank you, Julia, for being here tonight.
Thank you very much for having me, Margaret.
We always have so much to get through, and we never run out of things to talk about. So hopefully we're going to get you back again toward the end of the year, and we'll have another raft of information for property investors at that time. I'm pretty easy to reach. If you need me for anything, you can email me at pim@mypropertytv.com.au or connect with me via social media. Margaret Lomas on Facebook, Margaret Lomas Property on Instagram, and of course Margaret Lomas AU on Twitter. And as I always remind you, make sure that you go to my website, destiny.com.au, to become a VIP for my regular newsletter, and to also watch my free vidcasts, and to just find out more about just how I can help you with your own property journey. Don't forget to pop into Julia's website, bantacs.com.au. She has that much information there. You'll be weeks sorting through it, but there's some great guidance, so make sure you go there. Have an enjoyable week, and I will see you in 2 weeks for our next episode.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.